Welcome to Savings Guru TV, episode 3. Today's a peer-to-peer lending special, and I'm delighted that we're joined by Brian Bartaby from Proplend, who's an expert in the peer-to-peer lending sector. Brian, tell us a bit more about yourself and Proplend and how you kind of got going in this market.
Yep, morning. Thank you very much for inviting me on. So peer-to-peer lending has been around for a fair old time now. So we started back in 2005 with Zopa, who started doing consumer peer-to-peer loans. My background is I've been in property since 2003, raising finance for property investors and property developers. And when the sort of financial crash happened in 2007, 2008. A lot of property lenders, banks, building societies sort of started repositioning themselves or pulling out the market totally. And there became a requirement for new different types of lenders coming to the market. And seeing what Zopa had done in the consumer loan space, I thought there was an interesting prospect to try and bring a property-backed version of what they were doing into the market. And in actual fact, commercial real estate loan syndication is a very long established institutional asset class. Yep. So really all we're doing is taking an institutional asset class and turning it into more of an individual lender class.
So when did you get involved then with Proplend? When did you start?
So Proplend started back in 2013 as the concept. In 2014, early 2014, we did our very first loan, which was very much the old-fashioned way of calling people up and sort of using bits of paper and things like that. We did our first loan, and that worked okay. So we spent the next 9 months building some technology. And we're hands up. We're not a bunch of techies who've built a platform, then decided what we're going to lend. We're very much property-backed people who understand property and are trying to make that a more efficient process. So our first loan was done on the platform in late 2014, and then we started a secondary market in 2015, and then we've just been sort of growing steadily since then.
And the market itself, the wider peer-to-peer lending market, is about 11 billion lent now, 11, 12 billion, that sort of region. That's a pretty significant amount in a relatively short period of time, but I guess dwarfed by the 1.5 trillion in the savings market in general. What do you think needs to be done to encourage more people to consider the peer-to-peer lending market as a home for their cash?
Okay, I think so. We're probably about 16 billion in the UK so far to date. If you look at the US has done $92 billion. So there's massive room for growth. When you look at the peer-to-peer market, it's split into sort of three very distinct categories: consumer lending, SME lending, and then sort of property lending. And each of those has got their own little subsets. So there's massive room for growth. As you said, there's a huge amount of cash sitting in both in general savings and in sort of ISA savings as well. I think at the moment there is still quite a lack of understanding of what peer-to-peer really is. So there's a sort of massive marketing and more educational process that platforms need to do to try and explain in slightly more detail what peer-to-peer lending is, why it's not the same as putting cash into a savings account. Obviously, it's not covered by the Financial Services Compensation Scheme. Yep. It's a very different type of model, and it shouldn't be sold as such. It's sort of similar in a way to stocks and shares, where there is your capital is at risk when you're making those investments. But at the end of the day, it's a fixed income product. It's a fixed income product. It's similar to a bond or something like that. So I think it's just it's education both for the platforms and educating the end users, the potential retail investors, but also getting our sort of story across the wealth manager and the IFA market as well, because a lot of them are very sort of don't really understand fully what potentials it can offer.
Has the introduction of the innovative finance ISA, that's 2016, wasn't it? I think that came in.
It was.
Has that helped? Do you think that sort of helped to bring peer-to-peer more to the mainstream market?
It has somewhat. It's obviously given investors a different opportunity. I mean, the best way I can describe the innovative finance ISA is it gives higher returns than cash, but it's less volatile than the stocks and shares market, the stocks and shares ISA. It was a shame because although it started in 2016, in order to be able to offer an innovative finance ISA, platforms had to have full FCA authorization, and a lot of those authorizations only started coming through in the very late 2016, early 2017. So in that first year, I think there was about £36 million worth of funding went into the innovative finance ISA. Roll forward the next year, 2017-18, we've seen about £290 million going in, so it's a 700% increase in 1 year. This year we're obviously going to have to wait. We're coming up the year end. We're going to have to wait and see what the numbers come out at. But I do think there's been a considerable jump up, and I think the first adopters have been the people who already have an existing peer-to-peer lending account. They understand it. They sort of buy into the concept. They understand the opportunities that are there, and what they're doing is they're using either new subscriptions for their current year, or a lot of platforms are enabling investors to be able to move previous years ISA pots across to them as well. So I think that this next few years will be an important few years for the market for the innovative finance ISA. And I think I've sort of said to you before, the worst thing that can happen is there is a huge amount of money sitting within the ISA, both cash and or stocks and shares. And if suddenly that turns its attention to the innovative finance ISA, I think that would be a terrible thing, because the depth of borrowing requirement isn't there yet. So I think we need that slow drip. I mean, I think it's a long-term process. It's not something which I think a lot of platforms were hoping for, that suddenly the tap was going to turn on and they were going to be awash with funds. That would be the worst thing, because they wouldn't be able to, the investors wouldn't be able to deploy those funds. They wouldn't get returns on their money. So I think it's a long, slow process with the ISA. But I think it's definitely given it a certain sort of credence which maybe it didn't have before.
Yeah. I mean, you mentioned there, obviously, most cash savings are backed by the FSCS and peer-to-peer isn't, but then the stocks and share ISA, isn't backed by FSCS as well. Your money's at risk in that. Do you think that you'll see more money move in from stocks and shares, or do you think you'll see more people move from cash ISA subscriptions looking for a higher return but prepared to take the risk?
I don't think there's enough information on that yet. I mean, we find probably about 50-50 comes from cash and stocks and shares. And what you've got to remember as well is although it's wrapped as a stocks and shares ISA, a lot of people are sitting in cash in their stocks and shares ISA because they've maybe sold out some investments, something's come at the end of its term, they're still sitting in cash because they haven't found either the right thing or the right thing they want to invest into. Obviously the world's, especially in the UK, we've got a lot of potential volatility in the horizon with Brexit. So I think people are maybe sort of less keen to reinvest into that and are looking for something that might offer maybe slightly more stable returns over the longer term, with obviously less of the volatility that exists with the stocks and shares.
I think you mentioned Brexit. Obviously,
I tried not to get too early. Sorry,
it's a massive theme at the moment, isn't it? I think everything's been impacted by it, and what's going to happen changes on a day-to-day basis. It seems at the moment. Do you think if it happens, it will be a good thing for peer-to-peer, or a bad thing, or is it probably going to have little impact to the market? I
think it's going to have reasonably little impact. I mean, obviously, whatever type of platform it is, whether it's consumer, SME, or property, the investors on one side are UK participants, and the borrowers are UK participants. So there's less of an issue there. And I think a lot of the stuff that we do, a lot of stuff that's on it, are just the world will keep on turning. UK will keep on turning. The sort of things we're doing will still be requirements for those type of lending. The banks might, depending on what happens, struggle a little bit more, and that might be something that causes them to retrench a little bit further in what they can and what they're willing to lend against. So it might end up being something that opens the playing field up a bit more for the peer-to-peer platforms. But I think it's still very much business as usual. Obviously, people are maybe going to start to sort of dial back their credit policies just in line a little bit, just to see the next couple of years how it goes. But the world is going to keep on going, Britain's going to keep on going, and this requirement is suddenly not going to go away overnight.
You mentioned earlier about Zopa being the sort of the first entrant in the UK market here. They've recently announced plans to become a bank, and at the end of last year announced that they had got their banking licence, are in what we call in the industry mobilisation at the moment. We're expecting that they'll come out of that later in the summer. Do you think that's a bad thing for the industry, that they are they are converting into a bank, or do you think that might leave a gap for other people to come into the market behind them?
From what I understand, they still want to run the bank separately from the platform, so it's not they're turning the platform into a bank. I believe these are going to be sort of two separate entities. It's obviously Zopa's been around for quite a long while. They've got about 60,000, I believe, lenders on their platform, so they've got a very good, strong, loyal client base. To open a bank off the back of that is a great thing to be able to do. If you were any of the other banks that have gone out there and done a startup challenger bank today, the marketing budget you've got to put in and spend to get yourself 20, 30,000, 40,000 clients is fairly considerable, being a brand new startup, whereas Zopa have obviously got that sort of branding, PR, loyalty already built into them. So, I think they'll actually do quite well out of the bank, and it just depends on how, what products they're going to end up offering out of it, whether it's going to be more savings, more lending. I don't really know. And I don't think you're going to see it as a standard across the industry that every platform is suddenly going to turn themselves into a bank. I think that as far as I'm concerned, we're very much staying on the peer-to-peer sort of horizon and not looking off into the banking scenario.
Yeah, I can't imagine it would be an attractive model for many of the people in the sector, because it's a very different model.
It's a very different model. Yeah, it really is a very different model. And originally, peer-to-peer got the sort of the term shadow banking. Yeah. So there are some similarities. If you went back to the most basic forms of building society, where money was going in and the lending that happened from that building site was dependent on how much money was deposited. There was no leverage, so it was almost a pound in, 20 pence to run the building site, 80 pence gets lent out. Peer-to-peer platforms aren't that dissimilar in the fact that it's pound in, pound out. Whereas banks, obviously, a pound goes in and gets leveraged up X number of times and gets lent out. So obviously, that's where you can run into sort of issues on banking. So I think the peer-to-peer has got a good slot in the marketplace, and I think it's got an important role to play within business and sort of consumer lending in the UK.
I think you mentioned the building society sector there. There's a kind of feeling in our industry sometimes that some of the regional building societies benefit from Nationwide still being mutual because of their size. I wondered if there's a perhaps loss of benefit of if Zopa focuses more on the bank than the peer-to-peer lending model, that is less helpful for the sector in general, just because of the profile that the company has.
I mean, a lot of sort of focus does end up on the big three, so Zopa, Funding Circle, Rate Setter. So I think those three are running very different sort of business models. They're running very different types of lending. I think there's enough platforms out there not to just get drawn back to the Zopas and the Funding Circles and the Rate Setters. I think there's a lot of platforms that are very good at operating within niches because they're very good at those niches. Hopefully we can at some point be as big as they are. There tends to be those three were the first three out there. They've got a big jump on the rest of the industry. The rest of the industry is sort of trying to play a bit of catch up to them. But I think there's enough different types of lending and borrowing requirement out there that can cope with a reasonable amount of platforms. I think there probably will be some consolidation over the next few years, but I think there's still room for a reasonable amount of platforms out there.
You mentioned potential consolidation. We've seen in the savings market, we've seen 43 new entrants in the market since 2009. So we're fully exposed. We've seen some signs of that already recently with some mergers in the sector, and there's always talk of potential takeovers coming. I think that's where we're going. Do you think that will be something that we'll see to get that scale that you talked about? That's a challenge we have in the challenger bank sector.
It could be. Because half of the problem with peer-to-peer lending on the platforms is they run different business models. They look quite different. It might be difficult to try and actually sort of merge some of them together because I think we often get asked, what's your end plan? What are you trying to do? If you were going to sell, who would you sell to? And it's a very difficult thing because you have no idea who might or might not have an interest in the sort of peer-to-peer platforms. It could end up going full circle, and the banks coming back in and going, okay, we're really good at doing certain parts of our business. We understand we're not doing a great job down at maybe the lower end of the marketing, or lower end of the lending sector. Could 5 banks take a stake each in a peer-to-peer lending platform? That's the sort of thing. It could be insurance companies, it could be wealth management companies. I don't necessarily see that consolidation is definitely the way, but I think there will be some where there are 2 or 3 small consumer platforms could all go together. I think trying to put together a consumer and an SME and a property might be slightly more problematic, but we've seen some pretty interesting things happen in the world of finance and technology, so never say never.
You mentioned there about banks taking a stake. That was interesting. We've seen that in the challenger sector with likes of BBVA buying into Atom, probably the most high profile. Well, why do you think that's maybe not happened in the peer-to-peer? Do you think maybe some of the bigger banks have been too dismissive of the sector, or do you think it's not big enough yet for them to be looking to get involved? Do you think they'll wait a little bit longer?
I think when we've spoken to banks, just in general about what we do, a lot of the different sectors of the banks find it really interesting and think it's a great thing and wish they could almost help out more. It's trying to get the right part of the bank to actually look at us and go, okay, that is quite interesting. How can we work together? Because the banks are obviously just so big, they find it difficult to sort of concentrate and look at the smaller parts. Yeah. So I think that's once the banks sort of decide, okay, then what could happen is one bank will do it, and then suddenly all the banks will be like, we need to be in this now, and there'll suddenly be a bit of a rush for the door as everyone tries to sort of align themselves with someone. It would be great if, rather than being a single bank and a single platform, if they could take the wider view and go, okay, let's all take a bit of a stake in this and make it a bigger pie for everyone. Rather than it just being one bank, one platform. So
what do you think are the barriers that are stopping savers looking at the peer-to-peer market for some of their investment?
I think there's still a lack of good understanding. I think a lot of investors still obviously use the IFA and the wealth manager route to market in order to place their investments. So there is still a large amount of that going on. I think that the wealth managers and the IFAs don't really like, but I think just don't really understand it fully and don't really understand where it fits into their sort of investment profile for their clients. I think that's one thing. There is a lot of obviously digital sort of wealth manager. Now you can go onto the internet, you can log onto platforms, you can do all your KYC digitally over the internet, you can move money around. It's become a lot easier for the individual investor to actually decide, I am going to take more control of my own investment decisions. If they go right, then it's me. I've made my own decision. If it goes wrong, I can't really blame anyone else. I've done that. So I think there is definitely the scope to try and attract towards the more individual investor and try and get in front of them. I think we're still a niche product, and we still somehow need to rather than fight over the same client to try and bring them in, is to actually try and spread the word about where peer-to-peer fits into your investment portfolio, the benefits of it, the downsides of it. So it's more of I think we're probably 2-3 years of educational before we really should be start going out and spending marketing bucks about me trying to steal another platform's client away from them by I'm better than them, because it's more we actually need to be talking about the industry, and that's difficult because it's there is obviously a peer-to-peer finance association, but there's and the platforms have tried to do a bit of that, but I think we went through the initial position where everyone was going through the regulation with the FCA, so that was a big thing when the platforms sort of did do a bit of talking together to try and work out how we could work with the FCA, and that's all gone. The first bit of that's gone through. There's some new regulation coming in probably end of Q2 this year, maybe early Q3. We're just waiting to find out what the FCA is going to do. If anything, it's going to give a little bit more reassurance for the investors and more transparency. So again, when that comes in, it will give us another opportunity to go and sort of talk to the individual investors and sort of say, look, this is what you're getting yourself into. This is what you're investing in. Here's what we're doing. And if anything, hopefully it's going to be a little bit more transparent. The industry's going to have to be a little bit more transparent, which should help the individual investor make their lending decision or make their investment decision.
What would you say to a saver thinking about putting some of their monies into peer-to-peer? What would you sort of say were the key things that they should be looking for in a platform?
Well, obviously the most important thing is make sure they're FCA authorised and regulated. That's something you could very easily do by checking the FCA register. Have a look at how long they've been around for. Have a look at the volume of business they've done. Have a look at the amount of money they've returned to investors. Have a look at their sort of record of arrears or default. So there's obviously three different types. There's people doing consumer lending, so lending to you or me. If we need to go and borrow anything between a couple of hundred or £25,000 type thing. There's SME lending, so if you're a business and you decide that you want to set up a new bar, you want to expand your bar, you're at a restaurant, you're an engineering business, you need to make some more money, the bank's lending to you, you can do that. Or there's ones which are more asset backed, so property bridging, property development, buy-to-let loans, commercial mortgages. So probably try and have a good look through. There's a lot of information out on the internet right now about people who have done research on platforms, who have written up about them, who have given them either risk ratings or awards. And then it's just it's trying to understand exactly what you're getting yourself into. What am I lending against? Who am I lending to? How long am I lending for? Is the rate that I'm being, what rate am I actually, although I'm being offered this rate by the platform, what rate is the borrower actually paying? Because if I'm lending at 3-4, if I'm receiving 3 or 4%, I think I'm in a relatively low risk type investment. But if I find out that the borrower is actually paying 15-20, then obviously that's not the sort of low risk I thought I was getting myself into in the first place. So it's and hopefully that's part of what the FCA is going to do, is try and make that a more transparent process, so the lender has more transparency the whole way through. So I think just trying to sort of really understand what's going on and then sort of spread your risk across a few different platforms, just because obviously you don't want to have all your eggs in one basket. The only issue with the innovative finance ISA at the moment is you can only have one type of ISA, one type of innovative finance ISA in any one tax year. But obviously, if you have previous pots, then you can spread them around a little bit across different platforms. And as I say, there is a huge amount of information out there on the internet about people who have looked at platforms and have sort of made their sort of voices heard. Trustpilot again is a really good place to go and look. You tend to get quite good feedback from people who are already using the platform and who see their sort of niggles or things they like, with each individual platform. And
Proplend, obviously your company. What would you say are the reasons why savers should have a look at what you're doing and what you bring to the market that's a bit different?
So we're fairly unique in a couple of things. We're one of the only platforms who concentrates solely on commercial property, and we do that because commercial property generally has tenants in them. They're very simple structures, holding structures. So what you'll see is the tenants will be paying rental income into the structure, and then the borrower will be paying interest out. So it's generally not a trading company; it's just a pure holding company. And also, a lot of platforms try and put a risk rating on a certain loan. And the problem for the individual investor is some platforms use sort of castles, some platforms use padlocks, some platforms use stars, some use an ABCD structure. What I don't know as an investor is what's the difference between 3 stars and 4 stars, or 5 padlocks and 4 padlocks, and is 4 padlocks on one platform the same risk as 5 stars on another platform? We've gone back to something which we believe that everyone sort of has a fairly good understanding of, which is a loan-to-value based structure. So obviously, the lower down the capital structure that someone lends, then the safer that investment is. And we take the rate that the borrower pays, split it off into up to 3 loan-to-value based loan tranches, and then investors get the opportunity to invest either on a loan-by-loan basis against those 3 structures, or they can, again, a lot of platforms have what they call sort of an auto-lend or an auto-invest functionality, which means that if you don't either want to or have the expertise to go and pick and choose which loans, you can set some criteria around how you'd like your investments to be made, and then the platform, as loans become available, they invest into loans. So the only auto-lend product we offer is for our tranche A, which is our lowest risk tranche. So it's 50% loan to value. That means on day one, if if a loan's at 50% loan to value, there's 200%, of property value sitting above that loan. Property would have to fall by 50% before the initial borrower's capital was at risk.
I think that's something that I guess, in the interest of full disclosure, I have a small amount of investment in the Proplend platform. But I think that's the thing that really attracted me to what you're doing, the tranche A, tranche B, tranche C, and the fact that you can say, oh no, I don't want to lend more than 50% of the property value, and I'll accept that I'll get a slightly lower return therefore on that. Or you can say, actually, I'm really happy on that property to take more risk, and I'll go to the tranche C and take up to the 75% and understand that I'm going to therefore carry a little bit more risk. But it's very transparent what you're in for.
Yeah, I mean, it was obviously when we started, we knew we had to bring lots of investors to the table, but also lots of different types of investors. Not everyone's got the same sort of risk parameters and return requirements. So the best way we thought of doing that, and it's really the most institutional way, it's a very institutional way of doing CMBS or loan syndication, is a pure loan to value basis. It's formulaic, it's very transparent. Hopefully everyone, either through having their own mortgage, understands the loan to value metric. So it's just something that is a very simple way, and especially for the ISA products, we think should be as low risk as possible. It's generally people who've built up a bit of an ISA pot aren't getting the returns they were getting, or they used to be able to get in a cash ISA. They're looking for something which gives them a little bit of capital protection, but a bit of an income stream off the back of it. So that's really where we try to sort of to mould our tranche A ISA.
So when I do interviews like this with people in the savings industry, one of the questions I always ask is...
We're not in the savings industry.
We're not, no. But one of the questions I always ask is that, what do you think is going to happen in the future? So, if you were Chancellor for Exchequer today, what would you do to help the peer-to-peer lending industry, and where do you think the market is going over the next few years for the sector?
I think the Chancellor's probably got a few more problems to worry about than what's happening in the peer-to-peer industry at the moment. But I think obviously we need to keep a close eye on what's happening with interest rates and inflation, because obviously even if you've got cash sitting in a regular cash bank account, if inflation's still running higher, whilst you're not physically losing your cash, you're losing the buying power of that. So that's something we're very conscious of, to try and keep an eye on that. I think that the regulation side of it, I think it's more down to the FCA to keep an eye to maintain a nice sort of foothold over that. And I think that the increased regulation, which I think is going to come, is a good thing for the industry. I don't think any platform should be scared of some greater regulation, as long as it doesn't totally stifle the industry. And in the long term, I think sort of 2-3% is probably going to be the sort of what used to be the 5 to 7% of what we used to be sort of accustomed to in a bank rate. So I think there's still a lot of room for the peer-to-peer platforms to produce an attractive product within that market. I think that on the bank side, I think obviously they're being stifled by Basel II and Basel III, and I think there's more Basel 4, 5 and 6 coming down the line, and it isn't going to get any easier for the banks. So I think on the borrower side, I think there's still a lot of potential on the borrower side. So I think as long as we can sort of keep the country on some sort of relatively even footing, then I think there's room for there's a requirement for both the borrower on the lender side. We're quite unique in, I think maybe where banks somehow lost their way is they seem to forget they had two sets of customers. They remember they saw their customers as the borrowers, as money going out the door and earning income off that. What they sort of forgot, I think, a little bit about was the fact that people who are savers or investors with the banks are actually lending their money to the banks. It's ultimately the savers' money, and I think being a platform, you are very, very conscious that you've got two sets of clients, and you need to keep both of those clients sort of happy at all times, and try and match the borrower demand for loans with the investor demand for income, and not let one get ahead of the other. So I think it's definitely learning from some of the mistakes that maybe the banks made, and also with the bank, we don't have to lend money out. At the end of the day, it's our investors' money, and we're I think the building a good brand and a good trust with your investors is going to be absolutely paramount. And investors are very fickle these days. They've got lots of options, whether it's the traditional banks, whether it's the sort of new challenger banks, the sort of more digital banks. There's a lot of people out there trying to get the investors' attention, to try and get their pound out their pocket. So I think you've just got to try and be conscious that it's not your money, it's somebody else's money, and you've got to try and do the right thing by that.
Yeah. Do you think we'll see the market growing quite strongly then in the peer-to-peer sector? Do you think we'll see kicking on now? You sort of said it up to about 16 billion now invested. Do you think we'll see that grow quite strongly in the next few years?
I think it will grow strong. I think it will grow. Again, what I'd like to see steady growth rather than, I would hate to see it jump 100% in a year. I'd like to try and see slow and steady growth, because I think that, I don't think that peer-to-peer is a fad. I think it's going to be around. It's been around for, since 2005 already. I think there's definitely, it's here for the long term. As we turn more to running our lives off our mobile phones, running our investments off our mobile phones, being able to move money around quickly, being able to, point of purchase. At some point, could you buy a house and fund it at the point of purchase? Those are the sort of things that could be coming down the line in the way of, sort of peer-to-peer lending, peer-to-peer technology. So I think it's got a good future. There will be some bumps along the way. On some of the platforms, they are seeing some rise in sort of lender borrower arrear, borrower defaults. So it's about managing that process, making sure that as money suddenly comes into the market, that you don't suddenly drop your credit writing standards just in order to get the money out the door. But the platforms, I think, try and maintain a good standard and try and look after their clients. I think there's a strong and bright future for them.
I think it's a really exciting market, and I think that I'd certainly encourage people to have a look at it more closely. It's something that I've enjoyed having a look at and being involved with myself, and I hope that others will too. Thank you ever so much for coming and joining us today and sharing your wisdom on the sector with us.
My pleasure.
Cheers, Brian. Thank you.
Thank you very much.